Hey everyone, and welcome to another episode of Exponential Wealth. I am your host, Aaron Moore, and today's special guest, Matthew Falconer, the loan officer, mortgage lender, and branch manager from CrossCountry Mortgage based in Capitola, California. Been doing that for the last 23 years. Matthew helped me buy my first home. Privileged to have him on. Does consultative meetings, educational approach, same as we do here at SageCrest, and it is going to be a great conversation. So stick around. Matthew Falconer, welcome. So great to have you on the show.
Thank you, Aaron. It's glad to be here. I'm excited to share some information and talk with you. It's always a pleasure.
Matthew, this is my series of shows where it's all about real estate. The summer's coming, it's getting hotter, and we're going to be spending more and more time in our homes and our backyards. And I thought it was timely that we met, and we talk a lot, but I thought that it would be great for people that listen to the show, clients and prospects and everybody else out there, for us to get a chance to learn from one of the best to do it in the mortgage business. So thanks so much for being here.
Well, thank you for the kind words, and I love imparting knowledge. It's I think you and I are very much similar, and we like to just give education and knowledge so people can soak it up and do with it what they may. And it's good to be a part of this. So thank you for having me.
Matthew, I wanted to start, thank you for sharing that. I wanted to start with the story of how we met because I think it's timely and it will resonate with people who are in the market to buy a home. My brothers used to work in Hollywood, and when they're working on set, the cloud would move and then the director would say action, right? So everybody would just have to wait around all day for some external factor to change, and then they would jump on it. And in a lot of similar ways, your job is like that because people don't buy homes every day. It's kind of a once in a lifetime thing or twice in a lifetime. And when it comes down to is when the offer is accepted or right when they're about to get in the market or they find the place first. So when I went to go buy my house in Santa Cruz County many, many years ago, I was working with a mortgage lender who was a referral from a friend of mine. This gentleman went camping for the weekend. It was a long weekend. He went camping the day that our offer was accepted. And I hadn't gotten the pre-approval and hadn't gone through any of the process with him. He handed me off to another person at the bank. They dropped the ball, never got back to me. I was introduced to you, and you took it all the way across the finish line, and I had a great experience with you. So first of all, I wanted to say thank you because you're one of the main reasons that I got into homeownership personally, and I had such a great experience with you, really paved the way for what I'm doing now.
That's awesome. Yeah, and it's a great story to remember too, because I think this is funny. I've come to grips with people don't really want a mortgage; they want a house. So we're sort of a necessary evil. But there's a lot of upsides to the mortgage eventually for tax breaks and stuff, which we'll probably get into. But that's something that I can control is my communication and my availability, which I'm not available all the time. But real estate happens on weekends, and it's quite frequently I get the call where the borrowers aren't ready, or they see the house because again they want the house, they don't necessarily want a mortgage. The shiny object is what drives them to have to talk to me or a bank, because otherwise they can be daunted with what they really think is going to be required of them to get qualified for a mortgage.
Right.
So some
Matt,
places mask it. Sorry, some places mask it as it's a push button get mortgage, and it's really not that hard of a process. But when you do something like an online thing, you don't get any advice or tax advice or expertise or reputation, and all these little nuances are really what really sits at home and really helps people buy their house. It's kind of silly to borrow $1 million from pushing a button and hoping it works out. I'd say foolish.
well, what I really enjoyed about when we first met, and then every time we've met henceforth, and really what I try to do in this career is take a consultative approach, an educational approach. People don't understand the different terms. They don't understand all the language, or they hear things like, we're going to talk about this later, mortgage insurance. And oh my God, I would never take mortgage insurance. I was that person before you educated me on, listen, there's a proper way to do this. If it gets you in a home and it's the one you want, and there's these other extenuating circumstances that can help you, well, let that not be a barrier to entry. So I really appreciate that approach that you take. And I think that, you know, when I send business to you, my clients, I know are going to get the best experience when buying a home, which can be a very Very stressful experience. And so I just know that they're going to be in good hands. So
Yeah.
speaking of Matt, speaking of that, oh, did you want to say something? Sorry to
Well,
cut
I
you
want
off.
to comment on that a little bit because,
Yeah.
being not a big bank, the bank I manage a branch of CrossCountry Mortgage, which is a predominant mortgage bank across the United States. But each branch manager runs our own little local region. So mine in the Bay Area here. And we don't have a revolving door like a Chase or a Wells Fargo or the big banks where they're closed on the weekends. And if they don't answer their phone promptly or don't return their calls or emails, the next person's coming through the door. And I've understood that for a long time. And it's sort of the golden rule as well. I treat people like I'd like to be treated, answering phone calls, giving concise information, clear communication. But I know that if I stop being prompt and accurate, then my reputation is going to go downhill. So I always want to keep it top level because I don't have a revolving door of the big banks. So with that mindset, I'm always trying to be extremely customer service oriented and educate them because I like teaching people. And the downside is if I didn't return phone calls, no one's going to call me. I don't have that next person walk banging down my door. They're going to go to a bank. You know what I mean?
Yeah.
So it's important to just be on top of the customer service part for sure.
Yeah. No, for sure. For sure. Especially in this business where it's like, I mean, you gotta jump on these things when an offer comes in. If you're not have all your ducks in a row, and that's going to lead to my next question.
Okay.
If you don't have all those things lined up, if you don't have everyone ready to go, lined up, ready to go, you could lose the deal, and there's too much on the line for that to
Absolutely.
happen. So,
Yeah.
Matt, just kind of high level, just kind of the intro as we kind of drill down more into more of the what you and I like to talk about. Maybe the lay listener wouldn't find it as much interesting, but I hope they do, and I hope they keep listening. But for everyone that is going through the home buying process, they're going to go to a mortgage lender, break down kind of what that process is and what you kind of need to bring to the table when you're going through
Yeah.
that
Yeah.
process.
It's very simple. Sometimes I describe it as a recipe. The bank just wants to know that they're going to get paid back the money that the person wants to borrow. So what does the bank want to look at? Income, credit, and their down payment. It's not very difficult, really, to look at people's pay stubs or W-2s or tax returns. Not everyone needs every combination of that, by the way. If you're not self-employed, we probably don't need your tax returns, just some pay stubs. And it's
Yeah.
it's really pretty simple. It's also, in essence, just getting prepared. So if someone's going to buy the biggest thing that they've purchased by far their whole lifetime, hundreds of thousands to a few $1 million, we're in the Bay Area, so $1 million house is average at best, right?
Yeah.
So being prepared is just the smarter thing to do because you can get all the information. I can give all the information and answers and figure out all the nuances that they might want to know in advance of making an offer. And here's where it really matters too, is some people people don't understand this until they're in it. If borrower A is prepared and borrower B isn't prepared, this person's scrambling, this person's prepared. They both offer $1 million for the house, let's say, but this person has all their paperwork in early. We can go faster. We don't need some of the other baggage, so to speak, with this sort of slow pace offer. What offer is the seller going to take? The faster, better, stronger offer.
Yeah.
And especially on a long-term decision, if you want to live in that house for 30 years or however long you're going to live, I define real estate as a long-term hold for at least 7 to 10 years on a minimum level. So if you really want to live somewhere for 10 years, don't you think you should be prepared to make a good offer so you can actually win that house? Imagine if you weren't prepared, you find the house you love, and you're scrambling and you don't get it because you just didn't have your paperwork ready. It's kind of silly. So I really encourage people just to get in early. You don't buy a house, so be it. You just got some information and you wasted an hour of time talking to me about it. It's being
Not a
prepared.
waste of time, folks. Talking to Matthew about this process will educate you. It will not be a waste of time. Promise
True.
that.
I'm just saying that's the buy-in is
Right.
an hour of education really, which I would really think is very valuable. And it's funny because it's not binding. There's nothing that says you have to buy a house because you talk to a mortgage person, or when they talk to you, it doesn't mean they need to send you every penny they ever had. You're just educating them on why it would make sense or not make sense. Some people, the answer is no, and they need to know that, because that's just part of the process too. We have,
Yeah.
you and I are the gatekeepers for a lot of this stuff, right?
Yeah. We're the ones that I have a detailed understanding of a client's financial plan, and if it makes sense right now with what they have, with the current income and assets, if it makes sense to buy or to continue to rent or buy a
Yeah.
second home, right? Or to move up, whatever the question is.
Yeah, I want to
Matt,
say something too. Is a pre-approval is simply the bank's metric for the ceiling that the person can borrow, and that's great because we have to establish that ceiling. Otherwise, it just doesn't work, right?
right.
But what's more important is, or equally important, I should say, is that number affordable for the client? And so that's a lot where the advice piece comes in. Have they considered what the tax breaks look like? Do they know how everything else is going to look as a homeowner? Is that number affordable, or they're getting into, to something they can't really truly afford and being house poor, and not being able to contribute to their retirements and all the other things that they need to do to be, well-rounded investors, so to speak. But
Yeah.
you can't just jump into it and go strictly by the bank's number. Affordability is huge.
That's a great point. Matthew, I wanted to just one final piece on this topic while we're here. Um, we were talking before this about clients who drag their feet going through the pre-approval process, thinking that they need to wait, to get closer to the point that they buy. I mean, the client we were talking about earlier has a 2-month time window. They're looking to buy in the next 2 months. It seems like obvious that they would get pre-approval. When is a good time to seek out pre-approval through a mortgage lender such as yourself?
I would say at least 2 months, because you never know when the property is going to reveal itself. Like, that person might self-impose a 2-month timeline unless there's a really compelling event in 2 months, like they're going to get a big chunk of money or a new job or something like that. But they don't know if the house they're going to want to buy or live in is going to hit the market tomorrow. And so then again, they scramble because they're just not ready. So getting information early, the earlier the better. And the information is free. So I would say, well, and here's something else that's funny. The first of the year rolls around, obviously every year, and my phone rings off the hook because people have aspirations to buy a house, and as a New Year's resolution or whatever it may be, and they want to do this.
Huh.
And I think that's important, because that's when people kind of start to have that desire. So that's when they want to, like, hey, let's go find out some information. But when anyone has a burning question, I think they should reach out and just get the answers. You can go online, but it's not the full truth. It's some of the truth for lending.
Right. And so how long does that, so you get the pre-approval letter, you get an idea of the top level, high end of what you can, what a bank's comfortable loaning you. How long does that pre-approval last?
That's a good question. That one, people ask me that a long time, or a lot of times. It's 120 days from the date of the credit report.
It's
And
almost,
people also say, I don't want to get my credit pulled. It's going to hurt my credit. I don't want to ding on my credit. And that's kind of silly too, because a credit pull, first of all, impacts your score just to 3 or 4 points. And if you have great credit and you go from 800 to 795, it doesn't matter. Anything above 760 or more is great credit to the lender. Plus, you get those 3 or 4 points back anyways. And then there's the marginal credit people that they're trying to work on their credit, and those people should even allow us to pull their credit also, because then we can look at it as experts and say, hey, here's the roadmap to you getting a better credit score, or it's not as bad as you might think, because people speculate about all this stuff.
right.
We often limp in with the soft credit pull also, so it has zero impact to someone's credit score. It lets us look at the debts and the score and give them a good idea of where they're at.
Matthew, it makes me think one of the basic fundamentals of what I do is helping clients articulate financial goals that they can control. Like, I can't control what the market's going to do. You and I, we're not controlling what interest rates, what the Fed's going to do, and when they're going to cut. None of those things are in our control. So that even if you weren't ready, like, I love that at the beginning of the year, hey, I want to buy a house, like going through that pre-approval process. I'm even thinking for myself, like maybe I'm a year or 2 or 3 years away. But if I knew where I'm at now, have a target of what type of home I want to get into in the future, know where my score is at, know how much I could borrow. I'm going to have a very clear idea of where I was, where I'm at now, and what I need to do between now and then in order to get there. That's the fundamentals of financial planning. And I
Yeah.
encourage everyone listening to this to jump on this if this is your wake up call.
Yeah, and what you outlined is setting a plan. And when people don't have someone helping them, they guess. Oh, I need 20% down no matter what. No, you don't. Or some people, they don't know how much they really need down, or whatever the situation might be. When we as educators and advisors can help them formulate their own plan, because we've done it with so many other people, our brains work this way. When you have your eye on the actual real visual prize, you'll get there faster because it's real. When it's ambiguous, your brain doesn't really understand what you're trying to do. You're trying to accomplish these things, but it's vague. Your brain doesn't figure it out very well because it's vague. So helping us set a plan, people will figure it out because they know, oh, I need to save 50,000, or hey, I can buy a house today. And I love giving that news. Hey, you're good to go right now. And they're like, what? That's some of the, I love delivering good news. It's just fun.
Yeah, no, that's great. So Matthew, that's how to get started, contacting you, setting that engagement, the consultation, going through the pre-approval process. So now that we want to step into homeownership, people are overlooking, I feel like there's this constant argument between renting and buying, and we're here in the Bay Area. So it's more complicated because of just the entry point to real estate. But that being said, there's so many financial upsides to home ownership. Let's dive into some of them.
Okay. All right. Well, there's tax breaks for sure, which are vague to people, both when you buy the house, during your ownership, and when you sell. And so people, when they sell, they can defer capital gains tax of up to $500,000 if you're a married couple. That's the current tax rule, anyways. And by the way, I'm not a CPA, and you know these rules as well, of course, but we're not CPAs, so talk to somebody else about that. But if you can earn $500,000 and sell a house, you don't pay taxes on it because it's real estate and where you lived. So you get a huge tax break when you sell. Also, people that are, you get to deduct the interest you pay on your mortgage as a homeowner. So it's a huge number that's very vague to people. And it's also real specific to their tax bracket, to their income, to their interest rate, to how much they've borrowed, their mortgage size, their principal amount balance. It's a big number. Good news, I was telling you, I like to deliver. Today, I talked to someone who worked at Apple. He's heard about tax breaks. He's obviously a smart guy, does well. His tax breaks were $1,700 a month, and he didn't know that. He had some idea that they might get something, but when he's looking at a $7,000 mortgage payment, but now he has a tax breaks, making his paychecks bigger of 1,700. Well, it feels like 5,300 to him. His rent's 5,000. It's not the same, but it feels so much less daunting at 5,300 than 2,000 above his rent. So tax breaks are huge. I learned these things so long ago. A couple of them I didn't even understand 20 years ago when I started, 23 years. A hedge against inflation. A mortgage, a good mortgage, is fixed, it's flat. So can you imagine your payment in today's dollars? Let's just say it's $5,000. In 10 years, what is that going to feel like? In 20 years, what is that going to feel like as everything else goes up in inflated values?
And your mortgage is still $5,000.
Your mortgage doesn't move. It can only go down, which it will, because eventually, because people will refinance. We're in a fairly high rate market environment. It's not that high in like the grand scheme of things, but off the recent lows, it's pretty high, right? So we're around 7%. You know this, Aaron, but most people don't know that inflation is the leading edge of interest rates. So inflation goes up, rates go right behind it. It's like a roller coaster. Inflation goes down, then the rates go down. And so inflation's already well off its peak, and rates are coming off their peaks as well. We were over 8% last year, now around 7%. And so it's only going to get lower. That means someone can refinance from, let's just say 7 to 6 as an example. Gets cheaper.
Yeah, I mean, can you imagine a 6.5% interest rate seeming like a fair deal nowadays?
Yeah,
That's where we are.
But it has to be affordable. And so when you ask people, what they can afford, they don't say, I can afford a 6% interest rate. They say, I can afford 5,000. I can afford 6,000.
Right.
And the interest rate's important, but the market's not waiting for you to buy a house. People want to buy a house because they have an expanding family or their landlord's going to sell. Stability of that. So the market doesn't care when you're buying a house. The market just does what the market does.
Right.
But
Matthew, you
go ahead.
I just think that's so powerful. This idea that, I mean, yeah, the interest rates are higher today than they were a few years ago. But I mean, we'll get back into this, but yeah, you can refinance in the future. But just this idea that you have a fixed payment, unlike rent, you're in your home, you have a fixed payment. It hurts at first. When I bought here in San Mateo in 2020, it hurt. Now 4 years later, it feels like I'm just paying rent. I mean, and it's only been 4 years. So that's like, and it hasn't even been 5 or 10 years. So I think that is something that is just um, underappreciated with folks, of how you can control your expenses. And if you can control that fixed cost of housing, well, then the rest of your financial plan around that, well, then you can target other things more effectively and drill down and have more success in the other areas of life where you're saving.
100%, totally
Yeah.
100%. And then in your world of financial planning, you probably see the biggest bill of everyone's budget is their housing. And it's probably hard for you to make a plan if their housing is volatile.
Yep.
Plus, this is not a benefit of home ownership. I guess it is. It is, I guess. But I don't know how many dozens, if not 100 times, people have called me and said, "My landlord's selling the house, and now I have to go buy." And then we figure it out, but it's like that doesn't happen when you're a homeowner. It you're controlling it. And some of those worst stories are when people call me during the holidays, and the landlord has to sell their house for whatever their reason is. People die or they want to move back in. Like, they have their own reasons. It kind of always gets framed as the big bad landlord, but they have to do their own thing too. And so moving out during the holidays, those are not calls I like to field, when someone's like scrambling to buy a house because they can't have Christmas at their house. That sucks.
Hmm. I mean, they could get another rental, but even then, what if they don't find one in town? I
Yeah.
Matthew, my last interview was with a realtor, so this is part of a series of real estate, and that was something that we talked about. Was that came up in conversation? If you have to move because the landlord passed away, and now all the children have to divide the property, and they need cash to liquidate the estate,
Mhm.
whatever the reason is, um, you might have to move schools. Like, what if you get a new address and now your kids have to go to a different school, or now you're further away from a job? I mean, there's so many things that could be impacted. It's a laundry list of reasons why renting is it just introduces more risk, right, long term into your plan.
Yeah, yeah.
Um,
I've heard this. I'm not positive that it's true, but that rent is highly subjectable to inflation, and one of the biggest things that goes up with inflation as well. I've
yeah,
heard that a couple of times, so I assume it's true, but I'm not positive.
yeah. I mean, unless
Um,
you're in a rent control place, you have to be in a certain city. Around here, voters have rejected all the measures to impose rent control because there's a lot of landlords or people don't want those type of draconian rules.
sure.
So what that means, though, is that in and around San Mateo County, um, people's rent goes up regularly, and
Mhm.
there's not much they can do about it except cough it up.
Yeah, yeah, it's
They want to
true.
stay in the house.
Some of the other big benefits of owning a home too. Obviously, you get to live there. You get a tax write-off. It's going to appreciate eventually. Sometimes I peel that out of the equation and just say, what if it didn't go a dollar higher than what you bought it for? You still get all these other things. You're paying your loan down to zero through amortization, so it goes to zero eventually, and you own the home free and clear. Appreciation isn't really speculatory because it will happen. There's been no period over 10 years in the history of since like the Great Depression, I believe it was, where housing in California was worth less 10 years later than when you started.
Yeah,
Even through the big housing bubble, people that lost their houses, if they had just held on or could have held on, they would have had more equity. And imagine if they had that same value now. But they had to sell because there was poor loans, which really aren't available anymore. There's some
right.
creative loans, but 99% of the time we're totally vetting the client so they're qualified. Actually, this brings up a good point I used to always say. people qualified for that loan because it was a simple qualification, but was it affordable? No, it wasn't. So they lost their house.
Mm,
So banks metric qualify, cool, you fit the bill, not affordable.
yeah.
I don't, let's see, other benefits to owning a home is just the innate, it's like the American dream. And there's no tangible way of putting that except for that when you get to walk in and it's like you're the king of the castle, where there be a small condo or a castle. Um, it's amazing. It's your place, and that just feels awesome.
Yeah. Well, Matthew, the place that you helped me buy, I remember we got in there. The previous owners had a dog that just, kind of destroyed the place. We ripped up the carpet. I put in hardwood floors on the ground floor. And I did this on a teacher's salary. I was in a different profession back then. That's how long ago this was. I remember when it was all said and done, I had the furniture in there. It was just me. I sat down in the corner and I looked at the place. I will remember that feeling for the rest of my life. It was one of the best feelings I've ever had.
Yeah, you just feel kind of proud, and you're like, this is my little slice of paradise.
Yeah.
It's
Now,
awesome.
for family listening, obviously my wedding and having kids, that was also very important.
Of
But
course,
they're
very
not being
important.
interviewed right now. I'm interviewing the man
Yeah.
who helped me get my first place even before being married. That paved the way for all this other great stuff for me to have for it to happen in my life. So, all right, Matthew, let's switch to the next topic. Okay, so we want to buy. That's what we're promoting. Except certain scenarios, renting is fine, but we're not there today. Um, so some people want to buy, but they want to wait because interest rates are going to come down or the prices are going to, change. What's the case for buying now versus waiting? Why should someone not wait and dive
That's
in now?
yeah. Well, some of these answers are kind of counterintuitive to the normal person that doesn't know about this stuff. But as interest rates go down, buyers, so we're in a fairly high rate, right, environment right now, right?
Hmm.
So people are saying, it's unaffordable to me. Or they think it is because they won't even talk. They are going to sit on the sidelines and wait. So there's fewer buyers, and that's a huge thing because you have less competition right now. So if it's affordable, you have much weaker or fewer. You have less competition. Also, we're in a huge supply and demand problem right now. People don't want to sell their houses because they can't afford to buy another one or whatever it may be. As interest rates go down, it causes buyers to flood in, and it just compresses the supply and demand problem even more, which is going to push values up. So, for people that have been shopping, or maybe you remember this, Aaron, when the rates were really, really low, it was the world's on fire for you to go see a house. If you found a house that you liked, you had to like stop what you're doing, go there immediately and write a super aggressive offer, pay the seller 10% more than what they wanted just to barely get a chance at it. People are bidding non-contingent, which means just no strings attached. I'm going to buy the house, and bidding over and up just to win the property. They're overpaying sometimes.
Yeah.
That isn't the environment yet. It's coming back though. So that gives us right now a more balanced environment to where if it's affordable, remember I always go back to that, if it's affordable, you can negotiate some price. You don't need to break your neck to get in there and see the house. There's still a few people that want to buy it. It's Silicon Valley, it's California, but there's not 50 people that want to buy it, right?
Right.
And that is just giving people more opportunity to get in now. Prices are still creeping up. So imagine when the rates go down and 50 more people come in, the seller is going to be like, next, next, next. Okay, 200,000 more, $300,000 more. That happened and will happen again. It's just not happening right now. So it's a
Yeah.
great time to actually buy. Again, counterintuitive, high rates, less people to compete against. And the sellers sometimes, because there's fewer buyers, they'll negotiate. They will give you a credit to buy your lower interest rate. They'll allow you to close in 30 days instead of 15 and just ruin your whole life for 2 weeks just to buy the house. You can negotiate things, and it's just point blank a better environment right now.
Well,
Absolutely.
I hope that point sinks in for everyone listening. I mean, my clients that were trying to buy a home in 2021 were trying to put, like you said, 200 or $300,000 over and above asking price. If you got the home for $200,000 less and then just applied that towards the higher interest rate,
Yeah.
right? So then you're in the home. You could argue you're actually saving money with a higher interest rate because you're putting less down. And then in the future, when interest rates change and go down, hopefully, which I think they will long term,
Right.
well, then you have an opportunity to refinance. And then now you're in the home that you want. You're a homeowner. You've already got the ball rolling. So I think that's a great point, Matthew. I thank you for sharing that. I think that's
Yeah.
a great point that people need to
And
wake up to, that now's the
strictly
time.
from a math perspective too, I just use the easy number, and these are not, I don't have a calculator in front of me, but like, just let's pretend it's $1 million house right now at a 7% interest rate, and someone buys the house. Well, and then the other person waits. Rates go down to 6, market bumps in like 2 years, market's up 10% by then. So it's a $1.1 million house that they have to pay for the same exact house 2 years later at a lower interest rate. The payment is more because it's a $1.1 million house. The property taxes are more. And in 2 years, what did they lose? No appreciation. So they didn't get that $100,000 gain. No tax breaks for 2 years, probably something in the tune of, I don't know, $30,000 of tax breaks, and they didn't pay their loan down for 2 years. So they don't get these other ancillary benefits for 2 years. And that's hopefully, maybe the market's heating up. Hopefully the landlord doesn't sell their house in 2 years too.
Right. Knock on wood.
Yeah.
Well, the success stories are the clients that were trying to buy in 2021 are buying now in 2024 and are getting their offers accepted, and not that much over asking, which is all you can ask for. All
Yep.
right.
Yeah.
So no, that's great. All right. Well, I think we laid out the case pretty well, Matthew. I don't know much else. So in terms of, there was one thing about mortgage insurance, talking about the misconceptions of that, because, well, why don't we back up and talk about the 20% down? Because it seems like most people think that that's just the industry standard. I have to put 20% down on a home.
Yep.
Is that true? Is that the best way? And then what are other ways? And then how does mortgage insurance come in, and what should we know about that?
Yeah, so 20% down is one of the biggest misnomers in our industry, or for people, they think they have to put 20% down to buy a house, and that couldn't be further from the truth. Depending on the size of the loan, people can buy a house for as little as 3% down. And there are truly, pardon me, no money down programs for low to moderate people, income people that help qualify, or veterans can do no money down. But in general, most people, the average is 10% down, first of all, across the nation. And let's go back to 20% down, by the way, is the bank's metric for them saying, if the borrower were to default and that they don't pay us back, we at least have enough equity that we can sell the house and get our money back, between the selling costs, the legal costs, and all that stuff, the time of not getting paid. 20% down is a mark where we don't need insurance on this home. Mortgage insurance gets such a bad rap because it can be extremely inexpensive. And let's take again the $1 million person that wants to buy a house and thinks they need 20% down. They might have 10% down right now. They have 100,000. If they qualified, they could get a loan today for 900,000 and maybe have a mortgage insurance of $100 to $150 per month and buy a house today. Or they think they need to save an extra $100,000. How long would that take? So starting from here to here, is it 5 years? Is it 2 years? I mean, how much can they save and how fast? It's going to be a while for most people, unless they're coming into a huge chunk of money. But even then, now is actually better than it's going to be in 6 months. So what's better? They getting into the market now to the tune of paying maybe it probably wouldn't even be $200. I'd say $100 to $150 a month of mortgage insurance, or waiting X years until they have more money down, if it's affordable. Because the big difference there, really, it's not the $100 a month in mortgage insurance. It's the $800,000 loan compared to a $900,000 loan. You're borrowing more money.
Right. So you'll have a larger payment, essentially,
yeah,
with, obviously.
and get this too. Think from a bank's perspective. If I have a loan that the borrower is paying mortgage insurance on, it's risk-free. The bank is in a risk-free environment. So guess what? They give a lower interest rate than the person with 20% down, because there's still some risk there. If the borrower defaults, which is really rare these days, we're at an all-time low of foreclosures, by the way. the bank still has some risk there. You're at the very minimum risk level for them. But if you actually have insurance, they're in a no risk environment. They get a tiny bit better interest rate because it's from a risk mitigation standpoint, it's home free for them. So it's actually a better interest rate.
That's so fascinating. Matthew, this is stuff that you only learn when you sit down and talk to a mortgage lender, right? Or
Yeah.
else you just go around and just go around with your presumptions about how the world works.
Yeah, yeah. Or everyone's got the expert cousin or the expert colleague that bought a house one time 5 years ago, and they think they know it all. And people will listen to those people before they pick up the phone, which is kind
Yeah.
of funny.
And Matthew, I'll ask you the question. I know the answer. I'll ask you the question. When folks sit down with you, you can show them, here's what a 20% down looks like. Here's what putting 10% down looks like. Here's what putting 3% down looks like. Here's
Yep.
what mortgage insurance would look like. And then you would have all those numbers. You could take that to me or your financial advisor and analyze those. It's not like you get locked into those. You get to find out those numbers after talking with you.
Absolutely. It's just fact finding. And something, Aaron, I'll ask you a question off the cuff is, or just for fun. Do you know what percentage you need to put down to get the best interest rate?
I would assume the higher go up to 25% and you get the lowest interest
40%
rate.
down. So you
40.
put 40% down, you get the end all be all best interest rate if
Okay.
you have the best credit. And consumers, all they really know is what to ask is what is the interest rate? What's the interest rate? But so many things come into play. What's the property? What's your credit score? How much money do you have down? How long is the loan? Is it 30 years or 15 years? There's like 8 different factors, if not more.
Right.
But all they
It's
hear on
also
the radio is rates are blank. And that's just a teaser thing to get people to call some call center and who knows
right.
where.
Typically national numbers. I'm thinking too, if I put 40% down, I'm playing an interest rate game or a rate of return game because I'm taking an extra 20% that I could have invested or use
Yep.
or put into another investment property or anything.
Absolutely. Or,
Frankly.
people with that kind of money would be talking to you already, hopefully. And
Yep.
you could say to them, hey, well, if you put an extra $200,000-300,000 down and just to save a quarter of interest rate, well, you're earning them X% over here. I don't know what the average rate of return is or something, but I'm guessing
7
anywhere
to
between
9%.
yeah, 7 to 9. So why take hundreds of thousands of dollars out of earning 7 to 9% interest to save a quarter over here on this side? It really doesn't make sense. But again, even smart people with money try to optimize their interest rate, not knowing that there's a balance between your side and my side. By the way, I like to think of myself, I've self-appointed myself a debt planner, not a financial planner, but a debt planner.
Yeah. Yeah. I mean, debt is, I don't know if you've read, kind of an aside, Alan Greenspan, Capitalism in America. It's
Sounds like I should.
for anyone listening. It's a great book. You read these guys' books, and it's their book, right? So they get to write the introduction. They get to stand at the podium and just pontificate about the history of the United States and really lean into stuff. And so that's what Alan Greenspan does at the beginning of that book. The whole book's very fascinating. It talks about how economic success in this country. We're not going to talk about the pitfalls and who wasn't included, but on the grand scheme of things, for a large swath of people, have had more access to more capital than anywhere ever in the history of the world. And a big part of that is debt, like you just described, being able to use other people's money, creating banks, borrowing within reason, and using that to do something smart with that capital to earn money. And that right there is the essence of what I got from that book. And it really stuck with me. And it reminded me of what you just said, a debt manager.
Yeah. Well, and you just reminded me of something maybe I said this, I hope I didn't, but the benefit of homeownership is leveraging the bank's money. So going back to our same example of the $1 million house with 20% down, if that $1 million house with your $200,000 down, when it goes up to 1.2, you earned 200 on your 200. That's a 100% rate of return. You get 100% of the upside with only putting 20% down. You'd have to buy them. So same thing, you say you have $200,000 worth of stock or whatever, and it goes up, but it's a banner year from 200, you get 15%, let's say. Okay,
Yeah.
well, that 200, now you have 230,000. And that's a great return. That's a phenomenal return, but it's not a leveraged housing return, period.
And you don't get the same capital gains treatment, right? 250,000 as an individual and 500,000 as a married couple. I
Yeah,
mean,
or a
that's
place
that,
to live.
or a place to live, or the tax benefits, or pride of home ownership. I mean,
Yeah,
for me, it's like having my office, putting stuff up on the walls, painting it, bringing in furniture, new carpet, new windows, like all the things. Like imagine when I go back to renting, I was just a different person.
yeah,
Now that I'm a homeowner, I just think about the world differently. And I think that I will get back to pontificating, and I'll do my Alan Greenspan. If more people owned homes in America, there will be and had that pride of ownership, right? I think that we could alleviate a lot of social ills by creating homeowners, right? Because that's what people that's what drives people to
yeah,
want to clean up the neighborhood. Like if I put money out, I don't know where it's going, or it goes away, and I'm not seeing it. Well, what's my motivation,
right.
right?
Yeah,
But if I'm putting money into this thing and I get to look how beautiful it is, and then now my neighbors see how beautiful my home is, it's happening in my neighborhood where I live. We did our windows, we did the deck, and now the neighbors are like, "Oh my God, I see your place. It looks so beautiful. You inspired me to do this." And so we're
that's
we're
true.
having
That's
this
totally true.
reverberating effect in the neighborhood, right? That's kind of lifting everybody up.
That's totally true. And when you have skin in the game as a homeowner, you care a little more. You're going to keep your yard up, and you're going to, it's going to be a better neighborhood, period. And you can see that, unfortunately, with percentage of home ownership, depending on the economic area. So that's a really good point. You just made me think of something prior to that comment was having a balanced portfolio, right? And that's important for people to do. Sometimes, or many of my buyers have a lot of money in their stocks, and they have zero real estate. Almost everybody that we all know, if they have wealth, own homes, period. Either and they created wealth through homes. It's like extremely rare that someone is wealthy and doesn't own a house. It's like, yeah, it almost doesn't happen unless they're a nomad or something. Or the people that are gonna, like, we talked about the landlord selling a house, and so the heirs can have some money. Well, what are they going to do? They're going to go buy a house. But having a balanced portfolio for some people that have a lot of, like, our tech clients that have stocks and have done really well with RSUs, and then really maybe couldn't get a house because it was such a frenzy, and they're sitting on a lot of money. It's a little ambiguous for them to understand that they're really just diversifying from a portfolio into real estate, and now they're balanced. It's not like you're
Right.
lighting a match. You have the same amount of money. It's just now in equity, and it's growing in different aspects. So you're just diversifying into something else, into a different sector, which is, from a financial perspective, planner, I'm sure you would say, something smart to do.
Yep, absolutely, absolutely. Yeah, I mean, it makes sense. Our process is we go through the planning phase where we identify and articulate goals, identify resources, and really map it out. Um, but it is exciting to get back to the excitement when you get to tell a client that yes, you could buy a house. Um, just did a wire today, or just yesterday, did a wire for a client of ours, bought a property in Austin, Texas, and I'm so glad they did that because I feel like I lost a client back in 2017 who came to me and said, "Hey, should I buy in Austin, Texas?" And I wasn't sure. I go, "Hey, it looks good," but I wasn't as confident as I am now. Maybe I would have been more confident to say, yes, you should buy. But some of these decisions are really personal, and it's not just about the home, especially when you're buying an investment property. So, but I would encourage everyone to get pre-qualified, reach out to Matthew, myself, to find out about where you are in the process to see if now is the time, because I'm with you, Matthew. I think that now is the time to be looking. Now is the time to be getting your ducks in a row, to look to purchase your next home or your,
Yeah.
right? So
Or a home. I'm excited for your client, but I kind of want to be devil's advocate too and say, what was that price of the house 7 years ago? Because Austin's been booming for that long.
it's a
So what if
different
you
client.
bought it 7 years ago? But everyone has their personal timing too. Just because the market's great doesn't mean it's the right time for that person.
Yeah.
But
Yeah.
Austin's just blown up in the last 7 years.
I mean, I think it's sagged a little bit in terms of, I mean, it's not as hot as it was, but I mean, that could have as much to do with what we're talking about: interest rates, not as many sellers, not as many buyers, more people sitting on the sideline.
Yeah. Yeah. A lot
Hey,
of
but it's
people
not
are
California
buying
real
out.
estate. It is hot in Texas. Let me tell you that. It
Oh
is
yeah, that's
hot.
but we get a lot of people that are buying, second homes or selling out of California and going out of states for different reasons, retirement,
Yeah.
taxes, political reasons, obviously too. So it's nice that we
Yeah.
can help them across the country. That's one of the big things that's nice as a mortgage bank. We can do that.
Well, Matthew, let's end on that. If I have clients or prospects who are interested in buying investment property, so someone that I know that you do a lot here in California, but for example, this person in Texas or in Arizona, should they be coming to you and talking to you about buying investment property and how that fits into their plan here in California?
Absolutely should. Yeah.
Yep.
And thank you.
Awesome. Yeah.
And thank you again for having me because it's nice to just kind of talk and I remember all these things. It's just the basics of home ownership, which I really try to impart on people. So I hope just thank you for having me, and I hope we have some ears to listen and they can take some knowledge.
Amen. All right, Matthew. Hey, it's been a pleasure having you on the show. And I'll drop all of your contact information for listeners and viewers so they know how to get a hold of you. And I appreciate your time and I appreciate you. Thanks so
All right,
much, Matt.
thank you, Aaron.
Have a
All right,
great
have a
one.
good
All
day.
right, take care. Thanks again to Matthew Falconer of CrossCountry Mortgage, personal friend, and an amazing resource to all of us. So thanks, Matthew, for being on the show. Matthew and his company are not affiliated with SageCrest Financial nor LPL Financial. Aaron Moore, that's me, yours truly, is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisory, member FINRA and SIPC. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. The information is not intended to be a substitute for individualized financial, tax, or legal advice. Please consult your financial, tax, or legal advisor regarding your specific situation. Aaron Moore, SageCrest Wealth, Exponential Wealth Podcast. We will see you next time.